Okay. Okay. Servers, could we please just put a pause on clearing the plates? Thank you very much. Okay. So we have gone through a lot to get to where we are. If it's the excitement, let's say, of 2022, of holding on to the edges of our chair and watching the market tank, coming off the heels of what we saw in 2021, where the market really skyrocketed up. And then, of course, 2020 was a little bit of both, where the market plummeted down and then recovered quite nicely towards the end of the year. I was talking to Steve out here at the wine a few minutes ago. Steve, where are you? Over here. And he kind of put things into perspective. As we're preparing for this event tonight, we want to make sure we have all of our numbers and everything in order. But Steve just retired, and he was telling me how he's more busy now than he ever was when he was working. How many of you that are retired can relate to that statement? So the other half who did not raise their hands are probably not retired. We have a little saying in the TV that kind of scrolls through, and it says something to the lines that, welcome to retirement, you're now going to be more busy than you ever were before. But the truth is, everything that we do in the accumulation phase leading up to this point is so we can have the money that we need to do the things that we want, spend time with family, enjoy the time that we have left. And no matter what the stock market is doing, it's important to keep the context that the stock market is a tool. It's a tool that's designed to help you grow your money, but more importantly, as part of an overall financial plan. It's about how much income can I take? How long will my money last? How do I reduce risk? How do I pay less tax? And then how do I make sure the people I care most about are taken care of if something happens to me? So while we go through the first half review and the second half outlook, it's important to understand that the plan is the most important thing. Stocks, bonds, mutual funds, real estate, these are all financial tools that help us accomplish the goals that we set out to, which is generate income, pay less tax, and make sure that the people we love we can spend time with and that they're taken care of if something happens to us. So if we go back to the end of 2022, how many people thought the market was going to do really, really well this year? If you put yourself back into the emotional state that you were in November or December of last year. Warren raises his hand, but it's only because he watches every single one of Chris's videos.
And calls me occasionally.
So if you think back, when the market, and when we talk about the market, we have the S&P 500, we have the NASDAQ, we have the Dow. We're going to get into a bit of a dichotomy tonight when we talk about the divergence of these different indices over the past, let's call it 24 months. But when we look at where we were and where we are now, it's important to understand that when we turn on the TV, when we read the news, when we log into our email, when we get bombarded with all of this information, it's all designed to capture our attention. It's all designed to get us to tune in the next night. It's all designed to get us to keep watching so they sell more advertising dollars, so they get more clicks and they get more views. It's how the entire media complex is structured. So we want to start tonight's presentation by going through the first half outlook, and we're going to put it kind of right here behind you, that Chris did in January.
Yeah, it was written at the end of December.
It was written at the end of December, put out on the YouTube channel and sent to everyone in this room in early January. So Eric, if you could go ahead and roll the tape back here.
Opposite to how we closed out 2021 and entered 2022, we exit 2022 and enter 2023 with most sell-side strategists now pretty bearish on outcomes for the year, and investors with their highest weightings in cash in decades.
And we do think that this earnings season will be the beginning of the reset on 2023, which is really what's going to drive stocks. The full year estimates have to come down.
I will be stunned if we don't have a recession in 23. Don't know the timing, but certainly by the end of 23. I will not be surprised if it's not larger than the so-called average garden variety. And I don't rule out, not my forecast, but I don't rule out something really bad.
Our team expects the markets to continue to be volatile in the first half of 2023, but with a declining rate versus 2022. As the year progresses, both stock and bond markets should begin looking through 2022 actions of our Fed and other central banks and the economic slowdown they are causing, factoring in variables such as higher real interest rates, slowing inflation, and reduced 2023 earnings estimates. Markets and investors should begin looking through the valley towards the other side, where companies' marginal return on capital troughs and capital investment begins to improve. Let's call 4,300 an optimistic initial target for the S&P 500 sometime in the first half of 2023 if the Fed slows its pace and the markets can exhale and look across the valley.
Okay, so he used a lot of big words there, but so Chris, where was the S&P 500 in December whenever you wrote that?
It was 3,800 at the end of the year.
So I asked you guys a few minutes ago who felt that the market, based on where we were, based on what we had went through in 2022, who felt that the market was going to have a really good year this year. And I think Warren was the only person who raised his hand. And the S&P 500 was right around about 3,800. And the reason I bring this up is because the stock market is a discounting mechanism, meaning whatever is happening today, whatever happened last month, whatever happened 6 months ago, the stock market doesn't care about. But we as human beings, that's what we feel. That's where our state of mind is. And we get clouded based on this emotional impact that our accounts have reduced in value. Do we have enough? Can we still withdraw our income? How long will our money last? These are all the things that go through our minds. Our job at Oak Harvest Financial Group, and specifically the investment team at Oak Harvest Financial Group, is to sift through that clutter, to look at the numbers, to look at the data, and to understand the stock market for what it is. It's a discounting mechanism, which means it's looking at projected future profits from all the corporations in the market and trying to identify what we can purchase those cash flows for today. So the most important thing in that video was, Chris said optimistically, 4,300 is what we're looking at in the S&P 500. In the middle of the doom and gloom, the uncertainty, the ability to see what the stock market is actually telling us versus what the media is telling us is how we create the portfolio structures and how we want you guys to understand it's not what has happened, but it's where we feel we are going. So from 3,800 to 4,300 is a little under 20% or so. Who knows where the S&P 500 is right now? Tim? 45. So we saw, some of the quotes we saw there were a bunch of hedge fund managers, a bunch of, let's call them talking heads or pundits that we see on CNBC and Fox News and NBC all the time. But the prevailing opinion at that time was that we were either going to enter a recession in 2023 and the stock market most likely was not going to perform well. So my point in going through this, and this is, I encourage you, especially new clients, most of the faces I see in here are pretty familiar, but we've put this out for the past 4.5 years now, and each time Chris has done a remarkable job bringing down or distilling the actual information that we see in the economic data, in the statistical analysis, distilling it down to a very clear communication of where we see markets going, and he's done a great job. So the biggest thing that we can communicate when it comes to going through periods of uncertainty is to be able to try to at least sift through most of the noise, tune into the podcast, tune into the live streams that we do every single month, because our job, most importantly, is to keep you guys committed to your plans. Some of you are 10% stock. Some of you are 100% stock. And most of you are somewhere in between there. But how much ever you have allocated to the stock market is most importantly based on what you've told us your desire to spend income in retirement is, your overall objectives and goals. So no one in this room has more money in the stock market than they should have based on what they've told us they need and they want. Our job is to communicate to you what we really see So you can stay committed to that plan when the market is down because it doesn't feel good. It's not comfortable. But when the market is down, that's typically when we have the opportunity for the greatest returns over long periods of time. So with that introduction, I want to kind of turn it over to Chris Paris. Most of you know Charles Scavone, Director of Investments. And I want to kind of start by asking you, Chris, when you did the first half outlook leading into 2023 here, what were some of the big things that you saw, and why did you come to the conclusion that 4,300 on the optimistic side, somewhere in that range, when everyone else out there was saying we're entering into a recession, doom and gloom is on the horizon, sell your cash, call the kids, hide the wife. What'd you look at? What's happened or transpired over the past 6 months to get to where we are? And allow you to share some of your insight with us.
Thanks, Troy. Thank everyone for showing up. It's been 2.5 years since we did one of these in person. I hope the next 3 months aren't anything like 3 months after we did the last one, because that was right before COVID hit. So you'll be happy to know that you only have 4 slides in front of you as opposed to 14 to 20, which I think the last time I had behind me, that no one could read outside of the first row. So as Troy says, you know, if you turn on TV, it's about emotions. And if you look at my work that I do and that the team does, we try to take the emotions out of it. So to go forward and to look forward, you know, we look back. You have to look back. The stock markets are about behavioral finance, right? Emotions of investors, where they're putting their money, how they're feeling. Are they feeling good or bad? Do they have too much money in the market? Are they taking risk or they're not? Back in October of last year, I was prepping for this. October 14th last year. It's in a YouTube video. It's up on our channel. It's not on the separate Chris Paris investment YouTube channel. I think it's still on our Stock Hawk channel. There, it's titled October 14th, What Could Go Right? What could go right? Because everything on TV was negative. The stock market bottomed, anyone? The 15th, 13th, 15th.
Very good.
Yeah, right in between there. Okay. You know, what we put out back then was everyone was talking about inflation. Everyone's talking about, you know, the Federal Reserve. The market had already dropped 25.5% in roughly 9 months, right? I mean, if you look at the charts, it actually dropped almost 22%, I think, into mid-June in 6 months, right? Down 25.5%. That is a recession, right? Particularly back then, when you adjust for inflation, which inflation at the time was running 9%. So you add 9%, it's a minus 25%. Sorry, I got my minus sign. You get negative 35% in purchasing power. Any textbook you look up, any long-term history of the stock market, they say during a recession, if you ask us, what do you expect the portfolio to be down if you're invested in the S&P 500 during a recession? My answer, 30 to 35%. That's just kind of the minimum. You know, if it's a crash, it'll be down more than that in the economy. So back then, you know, we started looking at the data, and we were looking back historically because everyone says it's different this time. Chris, you know, it's a different administration, you know, different policies. You know, Europe, I think, was blowing up. We're invading, you know, Ukraine, Russia, China. It's always different. And on our website, we have some information about how different every year has been with headline stories that were fearful, whether it was wars or crashes. And the reasoning is always can be different, but the actions a lot of times aren't. The reactions aren't, because it's behavioral finance. So we look back and we're comparing time periods of Federal Reserve raising rates very quickly, the 70s, then in 1994, these kind of periods, and the market discounts these things quickly, right? The market actually went through a bear market because we went through an earnings recession and a real GDP recession in the first half of 2022. So, you know, as we started to pen the first half of 2023, we were looking at all this data about history, and a lot of institutional things that I like to talk about that I hired Charles to translate because he's much better at that. And Charles and I, for those people who don't know, we've known each other for approximately 30 years, back before we both lost our hair. We've worked in parallel positions at the same shops. He was my boss before. Now we work together to help manage your money at Oak Harvest. But you know, we were looking at what could go right in 2023. You know, we knew nothing about AI, right? We weren't about the hype that would surround AI, right? We knew more or less that the Fed would start to slow interest rates and inflation would come down. Everything you see on TV almost weekly is talking about government statistics. We've laid out a lot of historical data talking about you can't look at the historical data from the government, right? It's usually wrong and it's usually revised multiple times. So we try to find things that lead the markets. So one of our big premise was we'd have high volatility, but it would be coming down. And lower volatility in the market, trending wise, is positive for your portfolio. It's that simple. And it might not have felt like it for the first half, but every chart, every piece of data I can show you says, you know, when the Fed starts to slow interest rate increases, volatility comes down, the market goes up. I mean, you can turn off the TV. You know, Stanley Druckenmiller, brilliant individual. He's worth billions of dollars. He doesn't manage any money anymore. He manages his own money. And there's other people up there, Mike Wilson from Morgan Stanley, who's also brilliant. We follow his work. He's never managed any money. And the dad guy, what's the guy's name?
Kiyosaki, Robert Kiyosaki.
You know, he writes newsletters and books, never managed a dime of other people's money. Charles and myself and the team, we get paid for managing money and managing risk, right? Because it's real, it's your money, they're dollars, right? And so, you know, we had the outlook of 4,300. I said optimistically, people have asked, well, how come you didn't raise your outlook? I said, well, if you told me where volatility was going to go as of July 4th, I could have given you the number. And they're like, what do you mean? And my number was 44.25 with volatility where it was on July 4th. Okay, we're 80 points higher than that. We're 2% higher than that, and it's a couple weeks later. So, you know, we had inflation coming down, which no one believes, because everyone on TV is focused on, you know, what the Federal Reserve cares about Supercore. Supercore. I mean, like, up until the last year and a half, and I've been managing money for 30 years, I've never heard of people micromanaging an inflation number down to something called Supercore, which is, I think, wages and housing.
Wages
or
and
something.
housing, yeah.
You know, but all the things that lead, all the things that we consume, whether it's energy or lumber or everything that goes into making goods, it peaked last year. And those things lead. And things that lead were telling us that inflation's coming down, the stock market will go up. You know, it'll go up because our first slide is real interest rates. And there's a couple videos out over time that I've done that talk about the interest rate you see on TV is usually, right now it's 5% a treasury bill. That is two components. It's an inflation component and it's a real component, which is kind of the risk component. If you can bring up the first slide when you get a chance. And we follow this in real time. You can find it on the internet if you want. It's esoteric for institutional people generally. But if you look at this chart and tell me there's no correlation between the stock market and real interest rates, I'll tell you, you know, the data says otherwise.
And
right?
you all have this chart, just to jump in,
Yeah.
you all have this chart in your packet in front of you for those that can't see it.
Right.
So this is, and just to explain quickly what this is the, essentially it is the difference between inflation and interest rates.
Correct. It's the premium that you have to accept to buy a treasury bond. How does this relate to you if you own stocks? It affects the PE of your stocks.
Yep. So
people on TV are saying, oh, the market's too expensive at 20 times earnings. They were saying it was too expensive at 16 times earnings 6 months ago. So this tells you, I don't know if it's expensive or not. I know, if the real interest rate is going up, the PE of the overall market is going to have a hard time going up.
And so let's break that down, because it's important to see this and to hear this, but understand why it's important to you. So if interest rates were near zero, right? Here's interest rates. And as inflation was increasing in 2022, the net difference between inflation and interest rates, let's say inflation goes to 6, interest rates are at 0, the net difference there is 6, right? As that is changing over time, it impacts the price that investors are willing to pay for stocks, the difference between inflation and in interest rate. So that's what we call the real rate. And I actually kind of have them backwards there, but
It's okay.
the main thing and why it matters to you and why it's important is, if I'm a growth stock, let's say I'm NVIDIA. Everyone has heard of NVIDIA by now, which is up 190% this year or so. NVIDIA doesn't pay a dividend. NVIDIA takes all of its profits and reinvests into research and development or acquisitions. It's a growth stock. When you're a growth stock and you can borrow capital at very, very low interest rates, people can borrow money and invest in you, or you can borrow money and invest in all these projects and get higher returns on that invested money. When real interest rates start to change, that dynamic changes and growth stocks kind of fall out of favor. And that's why we saw last year, as inflation was changing and interest rates were creeping up, it changed the dynamic. And that's why you saw good companies like Apple and Microsoft and Amazon and NVIDIA. A lot of these companies last year, 30% down, 40% down, 50% down. Was it structural? Was it something wrong with the operating and businesses themselves? No, it wasn't. It was just the economic storms that were blowing through. So I guess my goal here is to kind of tie some of the institutional speak down to why it matters to you guys, and help convey not just why it contributed to performance last year, but how that is almost flipped on its head. And that's what this chart is showing here. It's flipped upside down, and now things are changing.
And I think a good thing to think about too is that numbers like inflation, they measure, what we're looking at is the rate of change. So we can all go out and complain that, the price of eggs or whatever is high, and it's still high, and it may remain high. But when price changes occur, when change is occurring, when the rate of change, right? So the first part of this chart where the real rate is going straight up, that's when inflation was rocking up very, very high. And that's because it was coming off such a low base. And so what Chris had referred to really is the fact that when we reach this point of sort of maximum inflation rate, right, you could still hear somebody get on the news and say, well, prices are still high. And they're right, but the market is looking through that because of the rate of change, right? Markets anticipate and look for change. Where is change occurring? Right? It's not static. Capital markets, whether it's equities or fixed income, are very dynamic. So you have to have a process and a thought process that allows you to understand what that dynamic looks like. And that's exactly what you've described and what you've done so well in incorporating that in our process.
I want to ask you guys, what is the difference between the focus of the news media and the focus of the stock markets?
Well, if you turn on CNBC, Bloomberg, or Fox News, if 1 out of 20 people that you hear on TV actually has ever managed money for other people, I'd be surprised. 1 out of 20, 1 out of 20, maybe. And of those, that one right now, because CNBC contributor is code for I get paid. CNBC is paying me. I have an arrangement with CNBC. I'm either paying them to be on or they're paying me back, because when I'm on, people don't change the channel. So you're not getting information, you're getting opinion. Like this, ours is our opinion too, right? And we're wrong just like everyone else is, but most of those people are being paid. There's money going back and forth.
So to my point, what I want to just make sure I communicate, the stock market is looking at what's going to happen in 12 months.
Yeah.
Right? The news media is looking at what's happening today.
Yeah.
And the stock market doesn't care what happens today. The stock market doesn't care what happened yesterday. It doesn't even care what's going to happen tomorrow. What happened 6 months, 12 months, Charles?
And you're exactly right. And we see it. And what we see is a certain price action or activity going on somewhere. And then there's a narrative that comes behind it and matches the narrative to whatever is going on. Well, that's completely backward looking, right? And so it's just amazing.
Can we go back to this chart one more time? I want to bring this up one more time because if you turn on TV, a lot of times you'll hear analysts and commentators argue a lot about valuation. Oh, that stock's expensive. It's a 19 times PE or 40 times PE. One of the arguments I will not get into with people is valuation, because valuation, it does not matter. The stock market doesn't care. It cares about marginal return on invested capital. And if there's any better, indicator of that is you go back to the internet bubble, and technology companies, they weren't doing any marketing. People were calling them up, placing orders. That's probably what's going on with AI right now with NVIDIA. People are calling them up saying, give me 1,000 chips. And they're like, well, you'll have them 6 months from now.
You talked about this a couple months ago. NVIDIA doesn't need salespeople.
They don't need salespeople.
Because everyone's calling and placing orders.
So this chart, if you look, there's a big oval down at the bottom. That's essentially when interest rates, started to move up. That was the peak in the stock market in November, December of 2021. And all you saw, as real rates were going up was the stock market go down. And it's not any surprise to me that as soon as real rates peaked, almost, I think it was to the week there that it circled, NVIDIA, Microsoft, every tech company you can imagine, even the bad ones, bottomed because they have a lot of their value way out in the future, versus companies that pay dividends and are slower growth. They're easier to value. When real rates, if and when they start to come back down, you're going to see both tech stocks go higher and the rest of the market go higher. Maybe not as fast, but you'll start to see a lot of catch up to the dividend stocks, which have been lagging year to date, right? They don't have the growth. A lot of them are in certain sectors that are out of favor when interest rates are rising or when inflation is rising, because they can't adjust fast. Someone had asked a couple months ago if we liked bank stocks or financial stocks, and the answer was no. And this was before Silicon Valley Bank blew up, and it was because interest rates were moving so fast they couldn't change their pricing. So we avoided most of that mess. They're starting to look interesting because interest rates are starting to calm down. So,
Charles?
The only thing I would add to that is that one of the things that we've noticed over the years is that some of these behavioral effects, they changed so rapidly. We feel as though, over the course of the first half of this year, we've had like the equivalent of 3 market cycles, right, within 6 months, because it's just certain trigger events happen and people now have the ability, the market's been divided so many different ways through the use of ETFs, sectors, and the ability of investors to trade, with no cost and such. And people tend to be in a herd mentality, and people all tend to move the same direction at the same time. So you begin to see these disparities that occur between different types of stocks. And one of the latest thing is AI. Every company, I guarantee you, as sure as I'm sitting here, every single company, regardless of what they do when they have their quarterly earnings call this quarter, is somehow going to mention AI, right? Because there is an affinity towards that.
Have you listened to a conference call? Obviously, we're just early into earnings season here after the second quarter, but have you listened to a conference call yet that
Fastenal,
they
that
do
sells
not mention AI?
that sells nuts and bolts, talks about how AI is improving
Their ability
efficiency
to
of their
sell nuts and bolts?
Yeah, they sell fasteners. It's a wonderful business and it's a great company. They don't really spend a whole lot of time with AI.
But if you mention it in your conference call, your stock's
Worth a couple
likely
points,
to
right?
to bump a couple of points. So I want to talk a little bit about the dichotomy that I mentioned earlier, because this is very important for you guys in the room. Last year, companies that were, let's say, less tech-oriented, less explosive growth-oriented, tended to do pretty well. Many of the oil and gas stocks, a lot of the consumer staples, Last year, when the markets were down double digits, they were actually up. They were positive performing companies. Meanwhile, Amazon and Microsoft and Apple and Google and you name it, the big companies were down massively, 20, 30, 40%. Almost on the change of the calendar, it flips. And this year, those same companies that were down 10, 20, or excuse me, 30, 40% last year are up 30, 40, 50, 70, 80% this year. But the companies that performed fairly well, generally speaking, last year are down this year, even though the market's doing tremendously well. So if I were to ask you guys, kind of pop quiz, we have the Dow Jones, the S&P 500, the NASDAQ. So I think most of us are aware the NASDAQ is mostly kind of tech focused. How much is the Dow Jones up this year, percentage-wise? Anyone aware of the number roughly? Take a guess. Excuse me? 3%? Yes, sir.
So total returns 4.5.
Yeah, close enough though.
Yep.
So the NASDAQ that we follow on TV is up closer to 40%. Whereas the Dow and companies similar to what we would find in the Dow, they're typically more mature companies, more stable in their revenue, not exciting as far as their product development and the technologies that they're launching, but more stable, more typically conservative with their business, operating businesses. Most of those companies are down 2, 3, 4% this year, up 3, 4, 5% this year. So when we turn the TV on and we see the markets are going through the roof, the majority of that growth is driven by a handful of companies. What would you say, 10, 12, 15 companies?
10, 15 companies, we refer to the sort of the phenomenon. We said it's math, right? It's sort of how these indexes are we don't want to get into the whole big discussion about it. It's how the indexes are created and what drives them. And that are at a position where just a handful of stocks are such a large portion of these indices that they drive the vast majority of the return. So when you turn on the TV, the market, the S&P 500 was up, 3% or whatever. Well, that's just truly measuring the returns of a handful of stocks that are just massively outperforming that have a very impactful position within an index. And so you get these big divergences, as Troy's describing, and we see that happen over time, and it's part of this infatuation, this behavioral aspect that folks have and the ability to do that, but it takes you off course longer term, because if you look at a longer term history, these things always converge. They always converge back. Capital markets, Chris used to say it all the time, there are a lot of inefficiencies short term in capital markets, but over time and over a full economic cycle or whatever it is, capital markets are actually very efficient. And it brings back into focus the value of these cash flows that are generated by some of these more mature companies, as opposed to the expectations of the future earnings of these other sort of sexier companies that are AI focused or whatever it may be.
So Chris has a chart here. I'm going to let him talk about it in just a second, but I want to take this opportunity to just talk about how important the planning is, because how many of you, if we were going to get in a plane right now, how many of you want Maverick from Top Gun to be the pilot? No one?
Yeah.
Someone back over here? It would be interesting. I would do it maybe once, but not for an entire retirement. You put me in first class with Delta or United, and I'm pretty comfortable. Let's get there safely and securely, and I'm more comfortable with that. So over the past 6 to 7 months, we see this massive divergence between the Dow Jones and the NASDAQ. 40% almost return over 6 months versus about 4%. But if we go back, the chart here is 557 days. Let's call it a year and a half.
So yeah, if you were to go back to when the market peaked in December of 2021 and hold the same indexes, the S&P 500 is still down. This is before today, so I ran it yesterday. The total return of the S&P 500 is minus 4.5%. That's with dividends. The equal weight S&P 500, so instead of market cap weighted, it's equal weight. It's down 4% total return. The Dow is down minus 2.5%. The NASDAQ is still down it's 11%. So almost all the returns are the same, except the NASDAQ, which is still down the most. And the paths to get there were wildly different.
So
right?
it's
Wildly different.
So, okay, so let's just isolate the two that we just talked about,
Okay.
the Dow Jones and the NASDAQ. So this year, the Dow Jones is up about 4. The NASDAQ is up almost 4D.
Right.
Going in this chart over the past, let's roughly 18 months.
The past year and a half, the Dow is down 2.5%, and the NASDAQ is still down 11%.
Okay, so if we're completely growth focused in our financial plan, and right now when you own those stocks, it feels really, really, really good. You know, you turn on the TV, you open your accounts, you see how much you're up. But as investment managers and financial planners, we don't necessarily look at what's happening over 6 months or 12 months. We're making decisions with your investment strategy and your retirement plan as to how can we get you through 30 years. And we build into your plans and the portfolios that we construct the idea that we are going to go through recessions. As Chris mentioned earlier, from peak to trough, we are expecting 30% declines on average in a recession. We build that expectation in to your financial plan. Meaning if we decide to put 60% or 75% or 90% or 20% into equities, we are projecting out based on inflation, based on your income, based on your longevity, based on how much money you want to leave to your kids, based on taxes, how much money we can have in stocks withstand multiple recessions over the next 30 years and still be okay. But when we look at these numbers and this is why I think this is so interesting, because we feel like the market is having a tremendous year. Really, there's about 20 companies that are having a tremendous year. The rest of the market is now, they're up 10%, they're up 8%, they're down 4%. But if we look over the past 18 months, if we expand that time frame, the divergence between the short-term movements, it's not so drastic. They're far more close together. And when they're constructing portfolios and your advisor is recommending an equity allocation, it's over a 5-year period, a 10-year period, a 20-year period. And I think that's the important. These short-term movements, once the paychecks stop, they become far more likely to impact our emotional comfort. But our job is to look at the objective analysis of how much you're spending, how long you need that money, all the things we've talked about, and say, you know what, we've baked in that this portfolio is going to be down 20%, and you're still going to be okay. And this is why we have you in this type of model or this type of investment. It's because we're not focused on anything except making sure that you have enough money to live, to spend, to grow with inflation, to pay less tax, to do all the things that we talk about on a daily basis. So while we're in these short-term gyrations of the market, I think it's just important to bring it back to the plan and why the plan is so important here.
So I don't want to spend the whole thing on what's happened the last 6 months, but so here's the chart. It's it's the next slide. Remember, we didn't know what was going to happen in the future. We wrote our piece in October, what could go right. Then our first half outlook was the old normal. You know, the new normal thing is gone. It's the old normal.
Sorry to interrupt you, Chris. What are we looking at?
This is the S&P 500.
The colored lines?
Daily bar chart.
Okay, so
with some arrows in there.
The color lines with the blue and the purple, that's the S&P 500 over what time frame?
That is since June of 2021.
Okay, so on the left-hand side is where the S&P 500 was in June of 2021. And then we see the market increasing with the candle chart there throughout 2021. We start to see the massive decline through 2022 as it moves down. And then we kind of see them move up, although quite volatile, with a lot of volatility into where we are now, correct?
Actually, what you're seeing is till the end of the year. So that is back when we wrote our piece, our positive piece, looking for 4,300. There's a little box in there, one of my favorite billionaire retired hedge fund managers named Ray Dalio, who's on TV almost daily, at the lows, tells the world cash is not trash, meaning it's okay to put money in short-term bonds, and there's no reason to really own stocks at the lows in the stock market. So you can fast forward there, Eric. So one of the reasons we were positive on the first half of the year was the election cycle. And when I talk about the election cycle, it's about fiscal stimulus from the government. It's not about politics. It's not if I'm a Republican or a Democrat or an independent. It's not about that. It's about whoever's in charge wanting to get reelected a couple years out and spending your money, whether you like it or not, in ways you might not like. And it's our job as an investment manager to ferret out where the investment opportunities are, not whether I like where they're spending the money, which, I'm not gonna even go there. It's our job to be a filter saying, hey, they're gonna spend the money, whether it's healthcare or infrastructure or defense or someplace, lower taxes, which is spending money when you have as much debt as we have. I might like those things, but our job as a money manager is to figure out what's it mean for your money in the stock market, right? And Troy and the advisor's job is to figure out what do those things mean from a tax perspective if things are going to change this year or down the road. So, if you can go to the next slide, Eric. So, we talked about a positive outlook, and eureka, things actually worked out as well, if not actually better than we expected. I have a math model. It's unpublished. It says, we published the outlook for the second half for the year end. I come up with 4,700 to 4,750, right? We were going to get to 4,500, I think, either now or later in the year. The second half outlook is titled The Old Normal, Down Then Up, right? Expecting the markets to have a period in the third quarter where they exhale. If you were perfect and you bought back in June of 2022 at that first low, you went from 0 stocks to 100% stocks, which no one does. You now have what kind of gain? You have a long-term capital gain. And instead of paying ordinary income tax, you get to pay capital gains tax. And you're like, I'm going to sell some stocks, right? Coming up in October, if you were lucky and said, hey, I went all in on October 14th or 15th, which no one does, you're going to have long-term gains in October. So there should be additional supply and sellers coming into the market who are like, I've been through enough of this the last year and a half, this volatility going from 15 to 35 back to 15. I want to take some cash out, and a 5% treasury that you for 1 year, it's fine. 2 years, maybe I want to invest there because an election's coming up next year and I don't want to hang around for whatever outcome that might be. So we have an outlook that is still positive for the year, even after a really good first half, historically speaking. And in some of our prior podcasts, we put the data out, and I'll post it again in future ones. It doesn't mean you have a bad second half. It also doesn't mean it's a straight line up, like many of us want in 2017, where the market went up almost every day, every week, for the entire year. I think the biggest down move in 2017 was 1.5%, right? So expect some volatility coming up here in the summer. And we will, as portfolio managers and managing your money, look for opportunities to find companies and industries that, as we look forward, whether it's the fourth quarter of this year or into 2024, have improving marginal return on invested capital, where each incremental dollar we give them earns a higher return, not a lower return.
So I guess I'm always looking at things from a planning side, right? So a lot of the companies that pay dividends, when we invest in companies that pay dividends, they're not just companies that pay dividends, they're companies that pay increasing dividends. So one of the reasons this is a viable strategy in retirement is because when you go through periods like 2022, where the market is depreciating in value and it can become a little bit scary, or times like 2023, where we turn on the television and everything seems to be doing really, really well, regardless of those two completely divergent paths, companies that pay increasing dividends are consistently paying you increasing levels of income. And it's not just oftentimes 1% or 2%, we're talking 4%, 6%, 7% is quite possible with increasing income from dividend stocks. So they're more boring, and they're not nearly as exciting as a lot of the artificial intelligence stories that we see on television and companies in the NASDAQ. But you know what? Every single person in this room, if I went around and privately asked you or told you I had a magic wand and it was a 50-50 bet, if I waved this wand, your wealth would either double or be cut in half. Not a single person in this room, I think, would say I'd take that 50-50 bet to double my wealth at the risk of it being cut in half. Now, while we can carve out growth strategies for a portion of the portfolio and focus on these companies like NVIDIA and Microsoft, and many of you have these companies, many of you have growth-focused portfolios. The majority of the people in this room, though, we want stability. We want to make sure that our money is going to be there for us. We don't want to see that we wake up one morning and the market is down significant, and we have those questions of, do we have enough? Is it going to be okay? So what I want to tie this back to, and we're going to kind of talk a little bit more about the second half outlook, is everyone in the room has a plan. And first and foremost, that plan is revolving around generating the income that you need and having that income increase over time. So before we come back to the second half outlook, and you started to touch on it there, Charles, I'm going to give you an opportunity to talk about what you've seen over the first half of this year, and more importantly, kind of transitioning into this second half outlook. What are some of the things that may carry forward? What are some of the things that people watching at home or here in the room, what should we be paying attention to? What is of significance as we're kind of in this, I just think it's so interesting. We've seen the market, especially the NASDAQ, as I said, rally so much after being so much down last year. What are some things of significance that we're kind of looking at right now as we transition into the second half of the year?
Well, I think Chris did a great job, so I don't have a whole lot big to add to that. What I would just echo is that, every summer we never know kind of what it is and what it may be. It's sort of like trying to forecast the unforecastable, but something always happens during the summer, and so you're at one of these points in the market in which there's risk, right? We're always are looking at things from a risk-reward standpoint. We've been rewarded pretty well for having had the right view. Now we see a period of time in which you typically will have increased volatility, some uncertainty, and that could pretty easily upset the apple cart on a short-term basis. So for us, the whole idea is just, keep your head down and stay focused and look at the data. Where are trends emerging? So maybe my tact on this might be thematically, what are we seeing? We spend a lot of time looking at data. We spend a lot of time listening to what companies say. We listen to what every company says. Company has to step up to the plate 4 times a year when they report their earnings and explain what they did, why they did it, and more importantly, what they're going to do. And that's what we're interested in. And so we follow that and see if the financial metrics that they're reporting, which is very important to us, matches what they're saying. Does the opportunity for them to continue to deliver these strong, solid, incremental returns on invested capital, does that still make sense? And so we're very focused on melding both we'll call it the quantitative portion, just the numbers, then listening to the company, seeing the quality of the management, what they're saying, what the opportunity is, and does that match up? And we call that our quantum mental process. It leads us into spots where we're listening to not only the companies we own, but their customers, their competitors, and their suppliers. And you look for themes to begin to emerge within the markets. And so just a handful of things we're seeing is like within healthcare, for instance, as a result of COVID, a lot of people put off elective procedures, particularly those related to hips, knees, things like that weren't emergency conditions for them. We also saw now that hospitals, we don't own any hospital stocks, but we listen to what they say. We listen to what some of the HMOs say. They're seeing a tremendous amount of volume, people coming in now that the doctors are available, the hospitals are available, getting hip and knee replacements. And so if you look within the healthcare sectors of all of our model portfolios, it's tilted towards med tech companies that provide hips, knees, minimally invasive surgery, heart valve replacement, things like that. Certainly within technology, we're very aware of what's going on with AI. We have always been very focused. We sort of laugh at it. We've been using every available piece of technology we possibly could find and test stuff constantly to help us manage massive amounts of data. And so we're always, and we just don't talk about it, right? A lot of other people like to go out there and talk about it. We use, natural language processing. We use tools that scrape the internet. We use everything. We use these products, and we say then that helps us discern what's real and what's just a bunch of hype, what's a press release.
Yeah, as Charles said, and what Charles is really pointed to is we're active managers, right? You aren't invested in an S&P 500 index fund with us. We've been doing active management for mutual funds, pension funds, hedge funds for 30 years apiece, right? So we're active managers. And with bringing Charles in expands the opportunity set of the types of industries we can invest in. We got questions for a couple of years. Troy will get questions from clients. What if Chris gets hit? What if by a bus or a Tesla? What if Troy gets hit?
Well, because you can't hear it coming.
This is the answer right now. But we're an active manager. Earlier this year, case in point, we bought an HMO company for some clients, and then we got some data within, I think it was a week. It might have been 2 weeks at the most. Like, not what we thought. We're selling it, and we got a number of calls. You just bought that. Why are you selling it? It's like, well, we think we made a mistake. Well, it's down $1. I can't remember. It might have been flat. About 2 weeks later, they came out, and one of these big HMO companies said, "Oh, our medical loss ratio, which is what they have to pay out, is going to be somewhere between like $500 million higher than expected," which is very unusual at the beginning of the year. And they cited baby boomers coming back in to the hospitals and getting elective surgeries after putting them off for 2 or 3 years. And they cited injuries from pickleball. Not kidding.
Yep.
Not kidding. $300 to $500 million estimate, right? Which is great if you own the knee and hip companies, but lousy if you own an insurance company. So we sold it. The name, doesn't matter, but it's a big weighting in a lot of the indexes. And it's pretty much, I think it's one of the worst performers in the Dow year to date. So we're an active manager. If we make a mistake, we're going to try to admit it as quick as we can and rectify it. There are no trading costs anymore, right? We can buy and sell stocks for zero. We're not day traders though, right? We're not going to flip a whole portfolio. We're going to, make marginal changes to your portfolio when we see fit and we see opportunities.
So I want to, before we kind of move to the question and answer portion, I just want to get a very clear communication to everyone watching, everyone in the room. With what we've seen in the first half of the year, second half outlook, kind of concise, succinct. Fast forward 12 months from now, what's a range of expectation of where we can see the...
I told you not to go to 2024.
No, 2023, or the end of this year.
Okay, 6 months.
Yeah. What did I say, 12?
Yeah.
Sorry. 2023, what are kind of the range of possible outcomes here?
Yeah. The possible outcome, I don't see, unless something crazy happens, China invades Taiwan, something that no one can predict, right? And if you listen to the Black Swan guy on TV, turn that off too, please. He's never managed money.
No.
He's a good book writer. But short of some unforecastable thing, during the summer, even in bull market, if this is a bull market, even in cyclical bull markets and recoveries, during the summer, the average down move is 3 to 5.5%. Okay, 3 to 5.5%, which would take the market back to where it was about 2 months ago, about 4,200. Okay. The second half of the year is usually pretty strong, but it's always almost very much back-end weighted to November, December, as you're coming into the end of the year, and people start to look out to the next year. And that would be 4750, something like that. The math I look at, I can't get to new all-time highs, hurrah, easily. To get there this year, you have to have volatility like totally evaporate, like 2017, where there was no volatility. Given what happened today, maybe that happens, but we're not in the maybe business, we're in the risk reward business. And in October last year and December last year, the risk reward was pretty high at 3,800. At 4,500, you know, that's like 5% upside the rest of the year. You can get a treasury that yields 5% for the next 6 months. You know, so it's you know, we still have a positive outlook for the year, but we should enter a choppy area.
So Charles, I'm gonna give you a chance to kind of give your opinion there, but a few very important things you kind of said there I want to break down. Last year, November, December, S&P 500 at about 3,800. So we talk about this a lot of times on your appointments when we talk about the asymmetrical risk versus return. If we're going to risk $1, we would like a potential expected return of maybe $2. Okay, so when the S&P 500 at the end of last year, it's down 20%. If we invest dollars then, the return upside is asymmetrical to the potential risk that we're taking. In a normal recession, we go peak to trough about 30%. If we're already down 25 and we invest dollars at that time, it's asymmetrical. Our return potential theoretically is higher than our risk potential because we don't have as much of, the hole can only go so much deeper. So what Chris is saying is a lot of the returns for 2023 have almost been brought forward in a much more rapid fashion. So right now we're not necessarily in, even though you'll hear recession and a lot of the kind of gloom and doom still on television, we've seen a lot of the gain that we expected in 2023 kind of pulled forward in the first 6 months of this year, volatility as well. A little bit of uncertainty over the next month or so in the summer, which is normal, but hitting 5,200, 5,500 on the S&P, 20% upside from here isn't likely. It's very, very difficult to see that. But Charles, and feel free to kind of take this in any direction you want, but if you want to discuss one thing that is possible or could happen, since we've seen such a divergence between these growth stocks with a focus on AI versus companies that are more stable and more consistent in their revenues. They don't have 30% profit margins, but for 30 years, they've had like 10% profit margins, and they've not performed real well this year. So there could be a possibility maybe of some convergence there, any possibility of something like that happening. And what do you see with respect to what Chris has said in the second half of this year?
Well, I'll say a couple of things. Number one, you stepped out on a dangerous limb because you said I could take this anywhere. That's one, all right? So I think what I know, I'd say secondly, you guys are killing it. That there's not a whole lot I can really add to that you haven't already covered. So this has been the easiest investment-related presentation I've given in a long time. The final thing I'll say to actually answer your question, and then I'll pipe down for a second, is to say that not only do I think that it's possible for this catch-up to occur, we're very probable, if you haven't gathered that, we're very data-driven and probabilistic sort of thinkers in how we approach this. I would say that there's not a possibility that there's going to be this catch-up between these two different types of stocks. It's probable, and we know that because of these historical relationships and just how it's just how capital markets work. So
yeah, what Charles says is true. I study a lot of history, of the stock market, and people say, oh, it looks like the dot-com bubble. So I go back and I look, and if it is, it's really early right now in the dot-com bubble. And if it's the dot-com bubble, that means the next 4 or 5 months, all the dividend stocks are going to work, more value-oriented stocks are going to work, while tech stocks are going to start to take a break. And then everything kind of works next year for the first half. That's what the dot-com bubble would look like. If you hear that on TV, oh, it's the dot-com bubble. Well, that's where we would be right now in the dot-com bubble. We're about halfway. So, but one of my comments when Troy is talking about these different styles is, and we're investment guys, right? We manage money. We let the planners and the advisors take care of the clients on a one-on-one basis. But we occasionally interact. I would say one of the things as a retiree or near retiree, one of the habits you want to break is looking at your portfolio 2 ways. When it's down, I lost this many dollars. But when the market goes up, by percentage, I'm only up 10%. You can't flip back and forth, right? you can spend dollars as a retiree, you can't spend percentages. So I would implore you to not go back and forth between the two, because you will drive yourself crazy and you'll never meet your goals and objectives.
And I want to tie it back again to everyone in the room here. So, no one in the room here, we have you concentrated in 8 or 10 technology stocks. Okay, so no one in the room is up 40%, right? But when we start to look at what could develop over the next 6 months, is the companies that are more stable, and we saw it somewhat to an extent today. Pepsi's a great example, right? Pepsi, no matter what's happening with AI, people are going to buy Frito-Lays in India, right? Maybe not the best example, but
It's perfect.
The CEO on today on TV called it an affordable luxury. It's like a Frito's affordable luxury because it's corn, salt, and oil.
Okay. It's nice to take pride in your product, but that might be going a little bit too far.
But my point there is that, so companies maybe that haven't done 80% in the first 6 months of this year, that a lot of you in this room own, they have the potential, even though the overall market, we may see, let's say 4%, 6%, 8% upside from now until the end of the year with the overall market. There are a lot of companies within the S&P 500 that we do own that have the potential to have a more natural convergence back to the mean. So it is a very, very interesting time because we've seen such tremendous volatility over the past 3 years since COVID. And when preparing for this, the more I thought about it, just the more interesting it became to me, the dynamic that we've seen, to where, oil and gas last year, best performing sector. Oil and gas this year, not doing very well. Technology last year down 40, 50, 60%. Technology this year up 50, 60, 80%. It's about balance, right? It's about balance. And that's why we don't want to, as investment managers, last year, oil and gas is doing good. We got a decent number of phone calls. Troy, why isn't 40% of my portfolio in oil and gas? Because it's doing well this year. Well, it's because we're not looking over a 6-month period. We're looking over a 6-year period. And we know if it's doing well this year, there's a good chance next year it doesn't. But we don't have the ability to see into the future. So we want to stay balanced. We want to manage risk and have, where we can, the opportunity for this asymmetrical return for units of risk that we're taking. So final words before we kind of get into Q&A here?
We need to you turned it over to me, so I'll answer everybody's questions. Unless it involves planning, and then we're punting to you.
So we had a couple pre-submitted questions. I just want to take the opportunity because it's going to come up here, I'm sure. Taxes. Okay, taxes. In 2026, the tax rates are changing. The tax brackets are changing. One of the things that we do over the past couple of years as retirement planners and tax planners, in 2020, many of you in the room did massive Roth conversions in March and April and May when the market was down. Last year, we also did Roth conversions, but we did them in the beginning of the year for most people here. Why am I talking about the timing of Roth conversions? Because this year in last year, I'm getting my years confused. 2021, we did them more in the beginning of the year because we felt, because of Chris's outlook, the market was going to go up. Last year, we were doing them throughout the year because last year was a bad year. My point here is if you have $1 million account and you convert 200,000 of your IRA to Roth, to a tax-free account, you've converted 20% of that account. If that $1 million drops to 500 and you convert the same dollar amount, 200,000, okay, you've moved 40% of that account to a tax-free place. When the market rebounds or those positions rebound, now that 200,000, let's say, grows to 400, it's all in a tax-free environment. So one of the big things we've been doing over the past 3 years with many of you in the room who do have these massively infested with taxes retirement accounts is taking advantage of the opportunity that volatility presents to move money out of these retirement accounts into the Roth IRAs. So incrementally, or I should say proportionally, we're moving more of that account to a state of being tax-free which allows that money to grow back tax-free, but also not worsen the problem inside the IRA, because if we just leave it there and then it rebounds and grows back, well, now we just have a big tax problem inside the IRA. So we got a lot of questions about taxes. 2026, the Tax Cuts and Jobs Act is going away. So we have 3 more years of lower taxes to take advantage of this. And just to give you an idea, the 24% tax bracket right now, you could have about $380,000 of income, married filing jointly, before you go into the next bracket. In 2026, it's not $380,000 of income you can have. It's going to be about 175, 180, in that range. So it literally cuts in half. If you think of it as a bucket, and when I'm doing income planning, tax planning, your advisor is, we're looking at, if we take 100,000 out, this bucket is filled up. Let's call it the 12% bucket. Now we take another 100,000 out. Now the 22% bucket is filled up. Those buckets in 3 years are being cut down. So if we don't address these tax challenges, you get to a state of forced distribution later in retirement where these buckets are cut in half, but you're forced to take out far more money than you need. So a lot of what we've been doing over the past 3 years is to combine, I don't want to say the opportunity that the market presents by being down and being volatile, but Trump tax cuts did create this opportunity for us to take more money out of these accounts. And when the market is down and we have the timing of doing those big conversions in those down years, proportionally, we're putting a larger percentage of that account into a tax-free account, but still paying the same dollars on the tax. I hope that makes sense. Usually I'm on a whiteboard drawing. So I just wanted, we had a lot of pre-submitted questions about taxes. How many microphones do we have? Just one. Okay, so anyone who wants to ask a question, kind of raise your hand. Heather's going to bring it over in a few minutes. I have one here, Charles, I want to kind of go through for you. Because it's a very, I love the way you kind of explained it to me.
Go ahead.
How influential, the question is, how influential is AI and what are we doing to invest in AI?
Oh, yeah. So it's a great question. It's obviously topical. And, we've seen a lot of companies that put out these wonderful press releases, and they're at the leading edge of technology, and they're working on wonderful ways to help humanity and improve productivity and the like. But it always takes me back to the story of Levi Strauss, who was back in the California gold rush days. He sold picks and shovels to all those brave souls who were willing to risk their lives every day to go and pan for gold in, California. And I always thought, at the end of the day, old Levi, he made a ton of money and went home and slept inside his house. And he was the arms merchant, right? That's the position we want to be in as investors. We're not smart enough to figure out who's going to win at the end of the day. But if we own the tools that are used, that people are willing to fund, the capital is there, the investment is there, we love to own those companies because it's a much safer way to play the development in AI.
Let's real quick, just I want to bring that back to the conversation of asymmetry when it comes to risk versus reward. So if you're looking for the next great AI company, okay, you have a tremendous amount of risk. Those are companies that could, be tremendously profitable and blow through the roof with their returns. 800% versus losing everything, let's say. But if you are investing in the companies that sell the semiconductors and the chips and so forth to those companies that are going to buy everything, now what you're doing is you're limiting to an extent your risk while creating a pretty stable cash flow situation where you can have a return expectation that is higher than the amount of risk that you're taking.
You don't have to worry about the claim jumper shooting you in the back. Yeah, that's exactly right. That's a beautiful explanation. The other thing that comes up is, do we use AI in our day-to-day activities in stock selection and in portfolio management? I sort of hinted at that earlier. I'd always laugh when I'd be up at a conference talking about, what our investment process is, and I'd discuss how we do it. And then some other guy would come up and basically say the same thing, but he'd do it in a more not eloquent way, but he'd use a lot of, big word, fancy terms for doing, making just what we view as the basic blocking and tackling seem much more interesting, right? We've used, natural language processing. We use services that we look at 28,000 stocks every day, right? How do you do that? You use a computer. You figure it out. That's why we were hired. How to manage data, how to manage information. We use services that scrape everything off the internet. We literally put a list of the ticker symbols of the names that we're interested in, and let the computer go and scrape the internet and tell us everything that's going on in those names, right? Is that AI? Right, some people would say it is. If you ask me, I'd say that's just a natural part of what we should be doing as investment managers. There was a question back over here.
Yeah, hi, good evening. So I get the logic of doing the Roth conversions sooner rather than later. How do you balance that against the trickle-on effects of Social Security taxing and IRMA for Medicare? So you're going to dramatically increase the amount of Social Security that gets taxed, and you're going to get hit by very large IRMA payments every month.
Excellent question. Thank you. Everyone over there hear him? So to summarize, how do you balance doing Roth conversions early versus the IRMA tax that you may incur, as well as possibly bringing extra Social Security into a state of taxation? And essentially, all of that adds to the cost on top of income taxes for doing that Roth conversion. So how do you balance that against the long-term benefit? So IRMA, for those who aren't maybe aware, is an acronym. It stands for Income Related Monthly Adjustment Amount, and it's a surtax on your Medicare premium. So whenever you cross over $175,000 of modified adjusted gross income as a married couple, the government starts deducting money from your Social Security as in the form of a Medicare tax. So if your income, you do a Roth conversion, now your income exceeds these levels, all of a sudden, either your Social Security check starts getting smaller, or you have a much larger tax bill that you have to pay. So if you increase the cost of Roth conversion, how do you balance that out in regards to the benefit versus the consideration in the future? Well, the one thing about IRMA, and we'll get into Social Security in a second, the one thing about IRMA is it's a one-time tax. Let's call it a tax. It's an excise tax. It's only once though, and it's a 2-year look back. So the government looks at your tax return 2 years ago to determine what your income was, and then imposes that tax this year on your income. If you do not do these Roth conversions, for many of you in the room, you will go from a one-time state of taxation with IRMA to a permanent state of IRMA taxation. Because once you hit required minimum distribution phase, this is the math that we do and we look at. Everyone's different here. For most of you though, you'll go, if you do not do these Roth conversions or do not take money out of the retirement account, you'll go from a state of only having to pay this IRMA tax for 1, 2, 3, maybe 4 years to a state of doing it for 25 years. Because once you hit required minimum distribution age, now you're in these IRMA tax brackets every single year because you're forced to distribute such a large amount out of your retirement account that you may have saved a little bit of money by not doing conversions in the early years, but because of the lack of foresight possibly, or just the lack of planning, you are permanently paying that tax. Now, in regards to Social Security, and I know you came to our Social Security Lunch and Learn workshop a couple of months ago, so you may know this, but most people I sit down with, whether they're new prospects or even sometimes clients, because what we talk about from a planning perspective, maybe you heard on the radio, maybe you watched the video, but the coolest thing about Roth conversions as it relates to Social Security is you can take $1 million out of a Roth, hyperbole, and it doesn't increase $1 Social Security taxation. If we hit age 70, let's say, and all of our money is in Roth, and let's say husband and wife take Social Security, you can have a Social Security of $100,000 a year. Do you know what your taxes are on Social Security at $100,000 a year? if you don't have to take money out of your IRA, you don't have any other income? Anyone? 0. 0%. Yep. $100,000 of Social Security income, 0 taxes. It might be like $100, $150, but effectively 0. So the power of so dividends are preferentially taxed. Capital gains, long-term capital gains are preferentially taxed. And Social Security also has preferential taxation, but you lose the preferences that the tax code provide for these 3 different items: dividends, long-term capital. I should have done that. Dividends, long-term capital gains, and Social Security, if you keep the money inside the retirement account, because then you're forced to distribute it. Not getting too complex here, but we have an income tax system, a long-term capital gain system. And whenever you're forced to take income out, you blow all of the preferential tax items inside the code for those things. So I guess kind of wrapping the question up, it's about long-term planning. And if you do these Roth conversions, you don't just reduce taxes typically long-term, you reduce your Medicare taxes, and you also reduce the taxation of your Social Security benefits. And just keep in mind, again, I can show any of this. We have videos on the YouTube channel, but very, very simple tax calculation to do. If you have no other income from required distributions, then your Social Security, married couple could have $100,000 from Social Security, pay 0 taxes. And then, not getting too complex, but the government is they create multiple different formulas for multiple different things. And we've all heard of probably modified adjusted gross income, but there are different calculations. There are different definitions of modified adjusted gross income. If I have $1 million in muni bonds, that income is tax-free, right? Muni bonds, let's say they're paying 4% right now. I can get $40,000 from tax-free income from muni bonds. Even though I don't pay income tax on it, that $40,000 goes into the calculation of how my Social Security is taxed. That $40,000 of tax-free income from municipal bonds can cause your Social Security income to be subject to taxes. So even though it's tax-free theoretically, what it does is it drags other sources of income into a state of taxation, when otherwise it would not. Roth distributions, while also 100% tax-free, do not drag other sources of income into a higher state of taxation. It is the only source of tax-free income that does not drag other sources into a state of taxation.
Is it safe to say our planning software has all these what-if scenarios?
It is, but it's also safe to say that generally speaking, for most people, that paying IRMA taxes for 1, 2, 3, or 4 years is, you're getting off easy. Because here's what you're also doing, is you're taking the risk of higher taxes and higher Medicare premiums off the table for the future. How many people, like right now, Medicare is basically insolvent, right? The trust fund is basically gone. Social Security, the trust fund, is gone in 10 years or so. So the government faces tough decisions. And one of the decisions that they face is, how are we going to finance the medical costs of a population that is retiring at a clip of 10,000 people per day? We do not have enough people coming into the workforce to replace those that are retiring. Oh, and on top of that, medical inflation is between 5 to 10%, typically, on average, annually. So who are they going to take the money from? Yeah, or you, right? So we have to be aware. I'm not saying that taxes will go up. I'm not saying Medicare premiums will be higher or IRMA taxes will be higher in the future, but we do have to acknowledge that it is possible that the government says, you know what, people in retirement that have incomes over 120,000, 130,000, they don't need that money. You know, maybe we increase the taxation on those people. And that's essentially what they've done with IRMA. You know, if you have income of over 175, you're paying higher taxes. Yes, sir. Go ahead. One more time. Does he still have it?
Yeah, and what do you think the chances are of starting to tax Roth?
0. Yes, sir. So taxing Roth?
Yeah.
Yeah, so he said, what are the chances of the government actually saying, you know what, you've already paid taxes on all this money, and we know we had an agreement with you, but now we're going to start to tax those Roth conversions. So there's a ton of precedent for this in case law. What the government would do if they decide to do it is cancel the Roth conversion, or say from this point forward, anyone who converts now, there's some different system in place. But there's going back on that and changing it for people who have already played by those rules. Then no, that would be unconstitutional. Okay, so he got me going about taxes.
Any other
I'm
questions?
passionate about this. Right behind you, Megan.
Thank you. So we're not quite retired yet. We're still contributing to a work 401k. Does it make any sense now? So we're about 3 years from probably drawing Social Security and retiring. Does it make sense now to start doing the 401k not pre-tax? Just let it be taxable now? Does that make any sense?
The general answer, and talk to whomever you're working with for sure, and have them run the specific analysis. But the general rule of thumb is if you're paying, let's say, 24% now, what we call your marginal income tax bracket. So if you put money into the Roth 401k, it's going to cost you 24% taxes. The general rule of thumb is if it's going to cost you 24% now, are you saving more in the future than that? So if you think you'll be paying 30% in the future, yeah, you're getting a discount now by paying 24%. But if it costs you 32% today and you think you're only going to pay 12% in the future, you should probably put it into the tax deferred part, not pay 32%, and then we'll deal with it once you retire and don't have an income. Then we can just move it over when you're in a lower tax rate. But it comes down to the overall analysis. So. Yes, sir. We're going to make you work, Heather.
Yeah. Hold on just a second.
Coming. We all want to hear. Thank you, sir.
Thank you. It's a little bit of a topical subject, but I'm curious about the potential long-term ramifications about it. One of the things that is happening is there's very low commercial real estate occupancy, particularly in cities like San Francisco, New York, Chicago. People have handed the keys back to real estate in a few hotels and properties in San Francisco. And while that affects real estate in that particular area, is there a possibility of that problem affecting the banks and rolling through the financial institutions? So I was just curious about your thoughts on that.
That's a good one.
Yeah.
Guys.
Yeah, so it's, it's a problem, you refer to it as being topical, but actually it's been ongoing for quite a while. So some folks have been in a position where they can address it and you begin to adjust. Some of the regional banks are lenders to those folks. And it is potentially a problem. And I know enough to know, never say never, but every indication we've had so far is that it doesn't seem as though it's going to be any sort of catalytic or cataclysmic type of event. But yeah, we certainly view it as being a problem, as you have pointed out. And so for us, we've massively cut down any real estate, particularly commercial real estate, or even anything tangentially related, because capital markets tend to view these things all as one. And so we've materially, cut back our exposure quite a lot and comfortable where we're at. And it's something that we're monitoring carefully. The good news is, as Chris alluded to earlier, we avoided a lot of the banks, right? And so the banks are part of the folks who, whoever finances these things are really the ones that own them, right? And if you can't make your payments on them, then that's where the problem resides. And so we don't see anything, cataclysmic happening, but we're certainly keeping an eye on it.
And I would just real quickly add that you touched on this earlier. watching themes develop while listening to conference calls from different companies that we invest in, but also listening to conference calls of companies that we don't invest in.
Yeah.
And paying attention to trends using whether it's AI or just normal computer programming and data analysis to identify which either directly related or tangentially related to this real estate problem, which companies have sales that are declining, margins that are decreasing, and overall profitability declining. And by paying attention to these themes and trends, I know I talked to Chris back in November and I said, what red flags do you see out there? And he said, right now, back in November, he said, it's commercial real estate. He said, if there was one big thing that we're concerned about over the next 6 months, it's commercial real estate. Nothing where we see the bottom dropping out, but it's something that we're paying attention to. So through the process of what we call the quantamental analysis, where we're looking at the quantitative side of the numbers, combined with the fundamental analysis of operating performance, when you pay attention to those trends and themes of the companies that are directly but also tangentially related to some of those commercial real estate, you start to identify the themes, and that's why they are a concern and they are things that we've recognized. Is it 2008 where it's structural and the entire financial system is going to collapse? No, we can't make that leap of faith yet. But paying attention to the trends and the themes and watching things develop is you guys are in it every day, but I'd say definitely probably top 2 or 3 on the radar.
Agreed. Yeah. And so what we do from a process standpoint in constructing the portfolios, the equity portfolios, is, we build these portfolios, one stock at a time. But to Troy's point, we do take a top-down view and make sure that those two things mesh. And is this top-down view, and if it's something like impending, bad trends in commercial real estate, then we make sure that that view is properly expressed through the individual names that we own.
Let's not forget what caused this, right? The Federal Reserve raising interest rates so rapidly compared to what the banks were planning.
And I'm going to touch on that. So people ask, well, what could go wrong, right? What keeps you up at night? The Federal Reserve keeps me up at night now, right? Because if you look at we are all our bios, right? I'm an engineer by trade. I'm a finance guy. I can't remember people's names, but I'm great with numbers, right? I am my bio, right? Look at the Federal Reserve. Look who's on it, and tell me they're not their bios. No one on that has ever worked in the regular world, right? Even Chairman Powell was, I think he was a lawyer at a private equity firm. So they say he has market experience. He doesn't, right? So you have a bunch of economists, politicians, academics, and lawyers running our monetary system. So if he decides, I don't want to be Harold Burns, who's a guy from the 70s who before?
I was thinking Volcker.
No, not Volcker.
It was before Volcker.
Not George Burns. The guy pre-Volcker, because he raised and lowered interest rates a bunch, and then Volcker came in and said, I'm not letting inflation get out of control. But if he decides that he's like, okay, I'm getting rid of inflation, I'm taking interest rates to 6%, 6.5%, because I need to see people lose their jobs. That's the solution to getting inflation down. Non-retirees fired is the solution to getting inflation down. You can easily see a scenario where the financial system gets rocky, and as we saw with Silicon Valley Bank, they went out of business in 5 days because some venture capitalist said, take your money out, right? I mean, it wasn't a great situation, but they were probably solvent at the time. And then a venture capitalist said, you need to take your money out, and there was a run on the bank because you can just, we can trade on our phone, right? I can move my money from Schwab to Fidelity, just like this. If it's a mutual fund, it takes a day. If it's a stock, it's the same day. So the thing that concerns me is that you have a bunch of ideological individuals running the Federal Reserve and academics who they don't have any sense for what the real world is. And the real world is, would you rather have full employment and people working and a little inflation, or would you rather have higher unemployment where we're paying them unemployment benefits, but inflation's down? It just doesn't make sense to me. So If they go too far, if they, do 20, they're doing 25 in a couple weeks, if they start to say, we have to do another 50 or something like that, that's will cause the market pullback. Does it get worse than a pullback? If they start they go to 6%, 6.5%, we're going to have a mess. The interest rate real yield curve that we look at, the market is okay with the Fed raising rates in July, a couple weeks, and it's trying to figure out, do they do any more? If they start to do more, the market is not going to like it. It's not going to like it, because you can go invest in a treasury at almost 6%, and the yield on the stock market is less than 2%. And then you're going to start to approach next year where you get out of the election cycle where, right now, there's some juice in the economy because whether you like it or not, the IRA, is writing a lot of checks. Inflation Reduction Act, horribly named, is writing a lot of checks to construction companies and developers for bringing, for constructing things to bring jobs back to America.
The CHIPS Act.
CHIPS Act.
So wait, the Inflation Reduction Act, this is where we printed a bunch of money and then gave it out and decided that was going to reduce inflation?
Yes.
Brilliant.
Yes. So all that money's, it's in the system now, it'll be in the system through the end of the year and probably the first half of next year. But as you get closer to the election, regardless of whether you're Democrat or Republican or independent, the market is likely to get much more nervous about the economy. And
It'll induce
gridlock,
risk.
yes, gridlock is good. Frozen is bad, right? You want gridlock in DC. You don't want things just frozen.
I have one more question back here, and then I think we're going to kind of wrap it up. And we're just really making sure the traffic dies down before we get to that.
Hi. Thank you for touching on the Federal Reserve rate, kind of what's been priced into the market, what they're expecting. Has the market priced in continuing drawdown on M2? Fed has been pulling money out of the economy. Now that we know there's a whole lot of people that thought they weren't going to be paying student loans, and they're going to start paying, September or October. We're seeing consumer credit rates increasing. We're seeing serious delinquencies, credit card debt, auto loans. Has the market priced in students are going to owe more that already have maxed out credit cards, that can't pay their car bills? And if the Fed then says we're going to raise rates another 50 basis points to the end of the year, have they priced all that in yet?
So I'll answer my ideas. We haven't talked about this. All the things you talk about are interesting. I have no idea, right? I've got an MBA from Harvard. I usually don't talk about it. I don't know. For managing money, the answer is no. They priced in 25 basis points. One of the things that people talk about the most on TV, which is absolutely useless, is Fed funds futures. There is zero predictive ability of Fed funds futures, which is economists and strategists pretty much saying, what's the Fed going to do? I study all this stuff. You go back and look at studies. The Fed is going to keep doing what they're doing until they stop doing what they're doing. That's it. They're a momentum. The Fed is a momentum investor, right? They raise, and they stop raising, and then they lower. So all those things interesting. Let me ask you this. Retrospectively, all those things are exactly the same things as they were 6 months ago, 9 months ago. The market's gone from 3,800 to 4,500. M2 is crashing. The Fed's balance sheet, which is supposed to be positively correlated, it's still shrinking. All of these things, credit, that was the boogeyman like 4 months ago. All interesting, but they're all questions I'll leave to economists while I try to find things that help us manage the money and not have, academic economist conversations about the market. I'll do it over cocktails and stuff like that. That's fun. But it doesn't help me manage a dime of money. It really doesn't.
I think ultimately what you're saying is the significance of those things is not as great as maybe some of the other primary drivers of the
That's-
overall market.
Yeah.
I'm his politician. Yes, sir.
I think we have one more.
Thank you. Just wondering, how much of what you do is affected by the federal deficit?
The deficit, or so the debt or the deficit? The debt. So overall, so yeah, how many people have seen he said how much of what we do is impacted by the overall debt, the federal debt? Has everyone seen the World Debt Clock? Have you ever went to that website where it's just constantly going? What are we at now? 31 trillion?
32. And that's just
I used
stated
to, some of you may have heard me say this before. Normally I say it in front of a crowd of strangers, but if we were to start, how do I say it? Okay, so $1 trillion. If we were to start to count to 1 trillion right now, 1,000, 2 1,000, 3 1,000, how long would it take us to count to 1 trillion? Does anyone remember? I've said it on the radio, I've said it in workshops, I've said it in the client events. 32,500 years roughly to count to 1 trillion. Yeah, it's a long time. 32,000 plus years to count to 1 trillion. So when we start to talk about $30 trillion of debt, it's an amount that we'll never pay back. One of the biggest things there is the fact that the dollar is the world's reserve currency. Now we get a lot of questions. It happens about every 8 years or so, where we have concerns of either China or Russia or the European bloc or some other currency possibly pushing us off the status of the world's reserve currency. But as long as most companies have to convert their currency into dollars to buy oil, to buy gas, to buy commodities, as long as we have the most stable economy, the most stable, even though it's a joke, but most stable political system, as long as we kind of lead the world in these core pillars, honestly, we could have far more debt than we do now, and no one is trading their dollars for rubles or, it's more your guys' area of expertise, but.
You sound like a better economist than the Federal Reserve.
That wouldn't be difficult.
It terrifies me, but so am I going to sit in cash for the next 30 years or gold? You could buy some gold. I look at it from the standpoint of, when did it start, right? Who's responsible for it, which is both parties, and who did it benefit, and is it going to continue, right? There's the only good thing about it is almost every large country in the world is in the exact same problem. China's got massive debt. Europe has massive debt. That's not a great answer.
Right.
Like everyone's doing it. It's not, I don't like debt, right? It steals from the future. It borrows from the future. We've driven consumption for years because of it. But
the bigger question, it's not even the debt or the bigger challenge. It's not our current debt. It's the unfunded liabilities, right? We talked about IRMA earlier, the Medicare premiums and the impact there. There are literally tens of trillions of dollars of unfunded Medicare liabilities. So if we're concerned about IRMA taxes, the future unfunded liabilities has a massive potential impact on that. So yeah, if you're concerned about the debt, let's get money out of those retirement accounts now into more areas of tax-free. So, okay, guys, we went probably 30. I don't know what time it is, but I know we're over our allotted time today. But thank you all very, very much for coming out today. You're welcome. We're going to sit up here for a little bit. If anyone didn't ask a question, feel free to come up and talk to us. But thank you all very much.